All right, today is Friday, August 21st, and this is a post market review for today's activities in the stock market. Per usual, we are covering the closing of the market, the sector's performance, the futures performance, the options market performance, the headlines that shaped the day, then the heat map analysis, and of course, the rotation analysis, and finishing with the charts analysis. So here we go, the Dow Industrial Average, aka Apple, closing in the green, 190.66 points or 0.69%. The Nasdaq closing in the green with 46.85 points or 0.48%. S&P 500 in the green, 11.65 points or an increase of 0.34%. The sector's performance, the gold medal goes to tech, silver to consumer cyclicals, and the bronze barely to utilities. The losers of the day led by material, energy, and communication services. And since this is the end of the week, let's take a look at the weekly performance. And for the week, the gold medal goes to consumer cyclicals, the silver goes to tech, and finally the bronze to communication services. The laggards for the week are energy, financials, and utilities. And switching to the futures market, look at Lombard, no stopping sign, 1,000 is the next destination. The dollar gaining today, grains building up on some of the gains yesterday. We saw the huge move in corn. And of course, the laggards here are silver, coffee, lean hogs declined a little today. Sugar been declining for a while now. We have support at 12.75 and the next support is at 12.45. We will see and watch if sugar will rebound from these levels. And moving on to the casino, the gamblers market, and it was action-packed today. Apple, look at this. The volume is about 3 million. We're talking options here, not stock. This is the Mania. This is one of the largest options volume I have ever seen, and it's just a symptom of what's going on in the market. The gamblers invaded and they're betting, and you see that Apple gamblers who gambled yesterday on today's closing, they scored big. And what happened is all the option riders that wrote the 485 and 490 and 495 calls, they had to buy them back, and this is why you saw at the end of the day Apple shares rallying up, because the options riders lost this week. Unlike last week, they took a big smack in the mouth and they had to cover those options that they wrote. Tesla is a different story because Tesla gamblers bet on the 2,100 level, aka the 420, and that didn't work out, so Tesla gamblers lost today. Nonetheless, the call options volume is unbelievable, and when you see that 74% of the options traded for Apple are calls, 66.7% for Tesla. It is absolute insanity. And now switching to the headlines that shape the day. And the first headline, of course, is the housing data that we had in the morning, up 25% for last month. And of course, the media had a massive orgasm over the number. They marketed the number as an advertisement for the V-shaped recovery and a sign that the economy is recovering. However, they did not provide any analysis and narrative for the number, so I will right now. The housing market is another indication and proof that this economy has become that of the haves and the have-nots. As we see over 1 million people applying for unemployment benefits every week, as we see 30 million Americans not having enough to eat, and as we see incomes and consumer purchasing power eroding overall in the economy, there are few pockets in the consumer purchasing power that are still strong. These are high-income individuals or individuals who've been working for big tech companies and big public companies and their jobs are still secured. They've been making money and saving for the last 10 years. Don't expect a few months' crisis to erode their entire purchasing power. They still have savings and they will continue to spend. But we are largely and increasingly becoming the haves and the have-nots, and a lot of those who thought they are in the haves category are slipping to the have-nots. Here is the data. When you look at the cash transactions for housing, these are rich people scooping properties for cheap prices due to the low mortgage rates. But the story is with first-time buyers. And these are not usually financially savvy people. They look at the mortgage rate and they are seduced by the sexy low mortgage rate. All they have to do is put a down payment from their savings, and now they're locked in a low interest mortgage for the next 30 years. This is a big mistake. Number one, because they don't know with this environment if they're going to still work for the same company or not, whether they need to move from this house or not. So the decision making is largely a knee-jerk reaction to the low mortgage rates. Remember, the Fed promises low interest rates, meaning the mortgage rates will continue to dwindle. You will not miss at all waiting out the market because mortgage rates will continue to decline. You will be able to lock even lower interest rates on your mortgage in the future. And here is what happens. As the demand skyrockets and you see the prices of lumber skyrocketing and you see more supply in the market, a big number of new construction is taking place right now to meet the demand. Remember, the construction number is a lagging indicator because here is what's going to happen. The majority of the FOMO first-time buyers will already buy their houses and lock the low mortgage rates or what they think is the low mortgage rates. And then a massive flood of supply of housing will enter the market as demand dwindles since first-time buyers already bought their houses. You will see a crash in home prices. They will get a lot lower. And now you're going to have a golden opportunity of home buying with prices down and mortgage interests even lower. So why buy now when you can wait for a better opportunity? Needless to say, this is not a good indication for the consumer purchasing power because we know that the have-nots are forgotten and they don't have any consumer purchasing power left. And now as the haves make these big commitment and big purchases, of course the biggest financial commitment is a house, they have drained their savings and they are likely to not commit in any big purchases in the future. Meaning they're not going to buy a car this year, they're probably not going to buy new iPhones, they're not going to spend a lot of money because they've already spent a lot of money buying the house, aka the down payment on the house. All of this information conclude that consumer purchasing power from the haves and the have-nots will dwindle and weaken. This is not a good indicator for the economy because the heart of the macroeconomy and the growth of any company is consumer spending. Now ask yourself, did you hear that analysis on TV today? No, you didn't. All you heard is the massive sound of the orgasm they all had when they heard that house sales increased 25% last month. You need to put it in context. And moving on to another headline, you can see the two pandemics. A pandemic that benefited big box retail, as you saw this week. Walmart earnings, Lowe's, Home Depot, Target, massive increase in sales. Meanwhile, small and medium businesses are going bankrupt. This is of course done due to the stupidity of our politicians. When they decided to do the lockdown, they did not think about their decision. All it did is it engineered the destruction of small businesses and the takeover of big businesses of the overall commerce industry. What they did is they shut the tap on small businesses and opened the floodgates to big box stores. If they did from the very beginning, if they've created a nationalized platform for small businesses so consumer can shop online from home from their small businesses, and they have utilized the mail service to deliver goods from small businesses around you to your house and incentivize that by canceling sales taxes on small business purchases. That would have accelerated and benefited small business during the pandemic, and we would have prevented a lot of the destruction that happened in the small and medium business sector. So the question now is how to fix it. You can do one thing. You have to create a new tax provision to add additional taxation on big box retailers that benefited from the pandemic because they did not benefit out of their genius. It was engineered by politicians to their favor. and they need to fix their mistake by taxing them, increasing the taxes on these big box retailers, and use the additional tax money as grants to small businesses nationwide. And before you cry and you say this is socialism, but we are a free country, I mean, I haven't seen so many poor people defending the rich in the worst pandemic and recession that we've ever had. But this is the kind of stupid environment we live in. But before you cry, wasn't it socialism or reverse socialism when the government engineered the rotation of commerce from small and medium businesses to big business? That was reverse socialism, and it needs to be fixed by actual socialism. And moving on, let's talk about the Fed, our favorite subject. The Fed, of course, only used a fraction of their $600 billion so-called Main Street program. Why haven't the Fed used more money to help Main Street? We know that they're buying Apple bonds, they're buying all these blue chip bonds, spending billions and billions of dollars, but they're not spending anything to help small and medium businesses. Why is that? The Fed is largely becoming an investment firm, printing money out of thin air and buying high-grade bonds to make actual money. There's a very sinister thing going on with the Fed, because why are they turning into an investment firm? That is not their job. Their job is to preserve employment and to control inflation and to stabilize the market. That is it. And of course, speaking of the market, here it is. The market is crying because Congress hasn't gotten to a deal with the stimulus yet. So they want the Fed to interfere with more liquidity. Yet, as we said, of course, small and medium businesses are not seeing any money from the $600 billion so-called Main Street program. Maybe we should check where that money went, perhaps in some of the Fed shell companies overseas. And by the way, did you know that the Fed has shell companies? How beautiful is that? And now moving on to the heat map. Here we go. You can see from the daily heat map that the breadth was really bad. It was only Apple and certain big box names leading us to the highs. This has been the story for the entire week. Here is the heat map for the week. And now you're hearing the media talking about market breadth more and more. What does that mean? When you have a rally and the market breadth is not good, meaning that the market is led by few names, that is a symptom of weakness in the market, that the market is not healthy and it's only being inflated by a bubble in certain names. This is exactly what happened during the dot-com bubble. I keep saying this over and over again. We knew or we know how that movie ended, and the movie we're in right now will end similarly. Now let's track the rotation. Here's the weekly performance of the tech sector, aka the garbage sector, versus the comeback stocks. Last week, you saw the comeback outperform tech. Now we're seeing the rotation of the rotation, and tech is outperforming comeback stocks, aka vaccine stocks. Will we see the rotation of the rotation of the rotation next week? Certainly possible if you thought this market is crazy, but wait, there is more. And now, switching to the charts analysis, let's start by the SPY S&P 500 15 minutes. As you can see, the SPY barely closed above all-time highs, but it counts. You have to give the SPY credit here because it was under pressure, especially at the end, but it caught a bid and it managed to close above all-time highs. When we switch to the weekly chart, you can see that the SPY closed above all-time highs weekly, so now it officially counts. This is bullish behavior. The chart is positive from that perspective alone. You have to take your biases. I know there are other information, and you could say, hey, it's only Apple driving the S&P 500. I do hear you, but when you do the technical analysis, you should take your biases out to make the technical analysis accurate. And then you combine what the technical charts are telling you with other information and come out with your own conclusion. And here is the triple Qs, the NASDAQ from a weekly perspective. Nothing new, intact, bullish until it's not. What about the dollar index? Here it is from a daily perspective. It looks like the dollar index is a little confused. Up one day, down another. Today it was up. So let's look at past cases that look exactly like the formation we're doing right now in the dollar index. Here is the bull case from 2008. You see the dollar index struggled to find a footing. It took its time, but it eventually did and rallied thereafter. Here is the bear case from the 2003 chart. The dollar did the same formation we're doing right now, declined, struggled, find a footing, back and forth, and it finally decided to go down and decline further. Our economic conditions are closer to the 2003 case versus the 2018, but anything is possible. We have so many factors controlling the dollar here, so you have to keep an open mind. However, me personally, I am bearish on the US dollar long term. The Fed wants to increase inflation. That is not going to happen with high dollar index, specifically given the fact that we are an importing nation. And now switching to the VIX chart. Here we go, a weekly chart of the VIX. Here is the first green weekly candle in the VIX for many, many weeks. Does it indicate anything? Can you read anything from it? Not right now. You just take it as it is because every other technical indicator like the MACD is still where it is. But if the market declines next week, look back at the VIX chart and this was your signal that the VIX is turning and trying to reverse course. It is not conclusive yet, but the market will always make it harder for you to see things. It's not going to announce it ahead of time clearly. It will give you little hints, little signals, and this one is a little hint and a little signal. Now, looking at the chart of the TNX, the 10-year note yield, and you can see the bull flag formation. Will this work out and play out? And will we see rates increasing higher? This is my bet looking at the yields. But remember, if we do have a market crash and a panic and a shift to bonds next week, yields will come under pressure. So we're keeping an eye on it, but we're not making any decisions regarding yields. And here we go. Let's conclude the video. The split mania is coming to an end finally. Today was the last day for the split record in Tesla. Monday will be the deadline for Apple, meaning that the majority of the split chase is over. And after the split, all the morons who pumped the stock and stampeded to buy Tesla and Apple shares will realize that nothing happened after the stock split. Ogats, nothing at all. Their positions remain the same, and the stock split was just an overhyped thing that they did not understand, but they thought it was positive for them. For my new subscribers and new followers, I've been telling my viewers for a long time, as Apple and Tesla go so well the market, not just because of their weighting in the S&P 500 and the NASDAQ respectively, but because they are a symptom of the mania in the stock market. They are the Robin Hoodiots and the gamblers' favorite stocks to chase and to bet on. They believe that Apple and Tesla are going to the moon and beyond and nothing will stop them, etc., etc. When Apple and Tesla sell off and decline, the market will follow suit. The bears will not gain control of the market until Apple and Tesla are finally defeated. We are getting very close to that point because the split mania is coming to an end. And after the split, when they realize nothing happened after the split, some of them will start hitting the sell button and booking their profits. And they will realize that all they did with the stock split mania is to make it attractive for bears and to shorts to invade these two names, Apple and Tesla. Shorts and bears are licking their chops waiting for the split to happen because shorting these two names and buying puts will be extremely cheap and extremely attractive at these stretched valuations. The bears will attack aggressively after the split, and we are about to see a massacre in the stock market led by Apple and Tesla shares being sliced and diced instead of being split. If you found the information presented in this video helpful, please subscribe, press the like button, the notification button, and follow me on social media.